Hi, it's Andrew Courtney once again. Thank you very much for clicking through to video number 3 of a Get Finance Fit video series, your clear path to success. As per all of the other videos, this is all general information only. Do not take this information and start implementing it yourself without getting advice. Don't take it as personal advice. It's all general information, and make sure that if you do stuff, make sure that you're comfortable with what you're doing so that you can sleep at night. I call that the sleep test as per what I talked about in video 2. Okay, moving on. So the agenda for the Get Finance Fit series is there's 5 videos. Video 1 and 2 we've already been through. Video 1 talking about the goals, cash flow management, that kind of stuff. Video 2 talks about building a portfolio, what kind of things to look out for, the different asset classes, return on investment, risk-free returns, cost of capital, that kind of stuff. Video number 3 today, we're going to be talking about property and how to bring property, investment properties. This is residential real estate, yeah, not commercial. Residential real estate within your portfolio, and what kind of stuff, pros and cons associated with having that in your portfolio. Video 4, superannuation. Video 5, the glue to bring it all together. Okay, moving forward. So what did we cover in video number 2? We covered off on cost of capital, risk-free return and return on investment, the financial decision-making framework. Very, very important to keep that in mind when you're making investment decisions. All right, so we also would have gone through the risk profile exercise. I hope you've clicked on one of the links below or in the previous video, purely because you get to find out what kind of investor you can be or you should be, depending on how you want to interpret it, and start building a portfolio accordingly. Right? Talked about the risk-return relationships and the different kinds of asset classes associated with that. Now, video number 3, which is the video right now, we'll be talking about property, why property, what to look out for, the pros and cons associated with it, land content, control versus ownership, what is negative and positive gearing, pros and cons associated with investing in it, right? The property's role in your portfolio. I alluded to it in the previous video, in video number 2. It's really nice to have an offset or a redraw account purely because it gives you the risk-free return of around 4 to 5%, depending on what kind of interest rate you're currently paying. Very, very cool stuff, purely because if you add tax on top of that, because you don't pay tax on that interest savings, right? If you add tax on top of that, it actually gets a loading of 32, 37 to 47%, depending on what kind of tax rate you're working with. Yeah, so very good stuff if you know what you're doing. And this is what this is all about, just educating you, trying to impart with you some good, solid financial knowledge so that you can actually start achieving your ideal income, which is from your investment portfolio for your survive, strive, and thrive numbers. Yeah. Now, we talked about the 3-pronged attack as per the previous video. Let's have a look at it once more. We're looking at income, aggressive, and leveraged, right? So today, with property, it falls in place in the leverage component. You do not want to put all your eggs in one basket with property, right? You want to make sure that you spread your risk across the table. And if you're starting out, property may be a good way to move forward for you so that you can start gaining more and more momentum moving forward. Yeah, something to consider at the very least, right? So like I said, income, this is where large chunks of cash stay in, providing you that 5 to 8% return. Moving forward, you've got the aggressive one, depending on where the market's at, depending on the cycle, right? So on a bull run, when the market's going up, you want to be loading up in here. And as the market creeps up, you want to be divesting as it gets as top heavy, right? You want to be divesting and moving more into the defensive income producing assets. Yeah, and then once the market crashes, you move over into aggressive again. Now the leverage component is a different aspect. So today we're going to be talking about property. Now there are multiple other options outside that we can use for investment within the investment universe. We won't be talking about any kind of derivatives or any funky stuff like that. We'll be just talking a basic residential property in this particular seminar. And you know what? I think it's still very, very potent. It's a fantastic asset class to own and control. We'll be going through that a little bit more because it gives you that asymmetric risk reward, right? It is the only asset class that the banks can lend upwards of 97%, right? It's the only asset class. That tells you something. It tells you that it's stable. Now, if you're buying the right property, you're doing really well for yourself. We're going to be going through how to go about doing so to ensure that you don't risk too much. And obviously, getting some help from licensed real estate agents may help with this stuff, but within the context of what I'm talking about too. Yeah, keep that in mind, because there's a lot of shonky information out there, and make sure that you have this foundation right so that you can move forward with confidence. Okay, pros and cons associated with residential property. Let's start with the cons. It's high cost to get in, there's minimal liquidity, high cost to get out, so you want to get it right. Yeah, it's hard to access your capital, liquidity, easy to make a mistake, right? If you do your research, you can start risk mitigating for these things. Overcapitalization when you're doing a renovation or when you're buying outright. You need to know what the suburb that you're working with is actually priced at. Yeah, it's a very, very long-term investment. You don't want to be getting in and out. Most people upgrade every 7 or so years, 5 to 7 years in property. They don't realize that if they do that over their whole lifetime, they're actually spending hundreds of thousands of dollars worth of costs associated with those transactions. Now imagine if you pocketed that. What kind of wealth curve will your wealth curve be looking like, right? Because ultimately what you want is that compounding effect. Yeah, you want it moving up. And the hardest part is the lift off, like I always say. And one of these lines that pushes your wealth curve down is the transaction cost for each and every trade or transaction you make within your portfolio. Property being 2 to 2.5, sometimes even 3% of the total value of your property is a sizable chunk out of your portfolio, pushing it down on every 5 to 7 year or maybe every decade basis. You do not want that kind of pressure on your wealth curve purely because it slows down the progress, slows down the momentum. This is all about momentum building so that you can achieve the ideal income. Keep harping on about it because that's what it's all about. Very, very important. Servicing multiple loans is hard and can be risky. Obviously, this stuff is based off the back of having a cash flow management system, in place. Very, very important, right? So we covered this off on video number 1, where the first thing, as soon as money comes in, it goes towards the things that you value the most. And I suggest you have investment and property as part of those things. And obviously you can branch out and create as many accounts as you want to sort of look at all of the things that you've got that you've written down on your dream line as per video 1. Yeah, but investment and property are the 2 big ones to keep this machine moving forward. That's the key with this thing. Yeah, servicing multiple loans can be very, very stressful, so you need to have this down pat. Otherwise, you could make a mess for yourself. Keeping records can be very, very laborious too. So make sure you start working with technology these days where you can actually start going paperless, for example, scanning everything up in the cloud, keep it secure, keep it ready so that when the accountants ask for it or when your financial advisors ask for it, you know where to look straight away and bang, send it through. Yeah. Now the pros associated with property is this: you're getting leverage returns. The biggest takeaway from property is this. Right? If you're buying property with 100% of the money at $400,000, let's say, right? And these 2 properties are the same, worth $400,000, right? What happens is if they grow by 10% over however many years, whether it be 1, 2, or 3 years, depending on whatever happens, that 10% on the 100%, right, on 400,000 has just made you 40K, right? Now, if you put in a 10% deposit, right, and you've got a debt, so there's 40K that you've got in there, and you've got a debt of 360K, purely on the capital portion, right? Not talking about income here. Obviously, there may be some costs associated with it. Probably is negatively geared. If you've got a tenant in there, it's going to cost a small amount. So let's ignore that for a second. Ultimately, it's gone up to 440 in 1 year, right? That $40,000 is actually 100%. You subtract the costs associated with holding onto that over that 1, 2, or 3 year period, it's gone up by 10%. And that $40,000, let's say, is around 35, 30, maybe 25, right? Still a sizable chunk on your initial equity. Something to consider. This is the major takeaway, and we'll be going through control versus ownership a little bit later. Yeah, it's a flexible asset when structured properly. You need to understand that this debt is good debt. Yeah, we'll be covering on that. Don't get it confused with bad debt, yeah? It is a massively powerful asset purely because of the leverage factor. If you can't leverage in property, you're wasting your time. It's a crappy asset to invest in my opinion, humble opinion. You can obviously create the leapfrog strategy, which we'll be covering off a little bit later, where you can start using the equity to acquire more and more and more and more, and then sit back, relax, watch your properties hopefully go up in value. If you do the research properly, you can be confident that your properties will increase in value purely because of supply and demand. We're not making any more land. Our country is very sparsely populated all across the board, but guess what? We are very, very concentrated in the big capital cities. And you know what? With concentration, increases the demand because it lowers the supply. Basic economics 101. Okay, so why residential property? Now, it's the only asset class that the banks will lend you up to 97% of the purchase price. It's a growth investment and it's historically stable, right? So these are the big three factors. You can control a property, right? If you were to buy some stocks, you can't get on the board of directors and start telling them what to do if you don't have billions of dollars in assets under management, yeah? If you've only got hundreds of thousands of dollars, property may be the right thing, because guess what? You can develop it, you can renovate it, you can hold on to it and renovate it at a later stage or develop it at a later stage. You can land bank, you can do all sorts of stuff with this thing because you've got control. That is the major differentiating factor with this one. It is creating an active investment philosophy though. So at this stage, you're a lot more active than these two here. So you're doing a little bit more to allow you higher returns on investment. That's what it comes down to, yeah? So it gives you a little bit more flexibility if you're keen to play in that space. Not everyone is, so you need to be aware of the risk associated with it as well. Now back to the portfolio synergy. It's understanding about the rules of the game, tax minimization, structure and strategy, control versus ownership, yeah? And diversification across asset classes. Right? Where does property play? Tax minimization is one of them. Control versus ownership is also a massive one. Structure and strategy is a big component of investing in property. Now, what is gearing? A lot of people get confused what gearing is. It's basically a fancy word for whether or not the property is making you money at the end of the year, positively geared, or if it's losing you money at the end of the year, negatively geared. Now, if it's losing you money at the end of the year, what happens is, let's say this particular property here is actually losing you, as an investor, approximately $4,000 per year, right? Now that $4,000 per year, because it's costing you out of pocket $4,000, the ATO, the tax associated with that actually gives you a bit of a discount. Whatever your marginal tax rate is, that $4,000 goes down by the percentage marginal tax rate. So let's assume, just for the sake of argument, that it's 30%. So instead of $4,000 out of your pocket on a year-to-year basis, that $4,000 now goes down to $2,800. So it's a bit of a discount. Now, if some of you there are in the above the 180K mark in terms of income, you're obviously getting a 47% discount on the costs associated with holding onto a property. When it's negatively geared and you're up in the higher echelons of the marginal tax rates, guess what? It is a strategy that you cannot afford to miss out on. Yeah, something to consider at the very least. Okay. Right, kinds of returns. There's income and growth as per previous videos. Income, growth. Property should be playing in the growth space. Structure for growth. A lot of people fall in love with positively geared cash flow properties. You know, it's a strategy. It's nice, but it's not going to get you to the ideal income fast enough, right? All you're doing is you're putting a few $1,000 more in your pocket in a year-to-year basis, when what you could do is you could put tens of thousands of dollars on your balance sheet as net assets on a year-to-year basis. Now, what do you do with that? We're going to be talking about that a little bit later. Okay, what to look out for? What are the pros and what are the cons associated? What are the pitfalls with buying property? Now, there are a lot of spruikers out there. People who are getting $30,000, $40,000, $50,000 on every single sale of every property. Therefore, it's in their best interest to sell these pieces of property, right? So please be aware, if you're buying new, if you're buying from a developer, they are getting paid a mint. You're paying a premium for these things. So you need to do your research and understand what you're getting into, because guess what? The opportunity cost is high. There's a 7 to 10 year gap before you start making some money on those investments. Something to consider. It's crazy how many people fall in love with the glitz and the glamour, the sparkly, the Miele appliances, all of those sparkly things that a lot of developers put in. You know, it may not be the best for your bottom line if you're trying to achieve your ideal income. Yeah, high density living. Now, you got to consider if you're living in a high density apartment, for example, more than 100, more than 15 really. What happens is all of these places are comparables to one another. I.e., if you're looking to sell your place, the first thing that the buyers typically look at is what is the most recent sale in your area. So you are burdened with the people who live in the same complex as you. It doesn't matter how beautiful your place is, right? If you're there, they're going to compare you with that one, that one, that one, that one, and that one, and that one, right? And what's going to happen is if they've had a divorce, if they've had a death in the family, they're forced to fire sale this apartment, you're going to be batched in with the fire sale price. And therefore, you run the risk of not being able to get your money out. And guess what? The valuers, the banks will actually look at that value too and say, you bought it at 500,000, but guess what? Your next door neighbor just sold theirs for 450, right? Therefore, your property has now gone down by $50,000. What are you going to do about it? That's the issue that you have with high density living, right? There's a lot of risk associated with investing in that, purely because if you're buying at a price and the valuer comes in and says, no, it's not valued at that price anymore, you need to stump up a little bit more equity, or in terms of a higher deposit amount, where you're going to find that money. You're forced to buy something that's not worth what it is. That's a harsh reality for a lot of property investors out there, purely because they're trying to save a whole bunch of tax. Do not invest for tax purposes only. Do not invest to reduce your tax liability. Please don't do that. It's one of the offshoots of investing. Do not do it for that specific purpose. Yeah? Buying above the median. Now, how the property market works is every single suburb is different, right? There's a range. Now, here are the numbers of properties sold, right? Within a year, let's hypothetically say. Now, this is the range of prices. Let's just call this 700K, 800K, 600K, 500K, 900K. If the median is 700K, you do not want to be buying above the median price. If you are an investor, that is, right? Obviously, if you're looking at a principal place of residence, maybe a little bit above, that's good, but not too far above. You do not want to be buying at 900K when the median's 700. You get caught out. You have to be very, very careful, right? You got to look at how the median is placed in the market. Is there a disparity in there? Because if you're buying below the median, it's really hard to get it wrong. How do you get this data? Click on one of the links below. We'll give you some suburb reports and it'll be on one of those graphs. Yeah, we're here to provide good education so that you can actually get a fighting chance of achieving your ideal income. Yeah. Also, if you can, share this with your friends so that you can actually work together as a team to achieve that ideal income and hopefully, make a positive difference in the world. Yeah. Getting in the market just to get in. Now, there are a whole range of people out there who are chomping at the bit to just get in the property market. They don't care what it is, they just want in. They think every single property will rise in value. Not the case. You need to be extra vigilant and extra careful on how you do it, purely because you could be wasting 5 to 10 years of your time, increasing the opportunity cost, losing more time, and not getting to your ideal income fast enough or sooner. Yeah, these are the massive pitfalls out there. But please, please, please stay away from property spruikers. All they want to do is line their pockets with cash, with their commissions when they're selling that thing. They're very, very biased individuals. You want to be working with professionals that aren't biased. And one of the big questions that you should be asking all of the professionals that you work with is, how do you get paid? Everything needs to be transparent and upfront with this thing. If they're not transparent and upfront with you, I suggest you start asking more questions, and if you're not comfortable, walk away. It's really that simple. Land content is king. Yeah? So if you look at this is Brisbane right now. There's concentric circles there. There's 5 kilometer, 10 kilometer, and 15 kilometers concentric circles. Now these are the hotspots. You know, you're going to find a few different suburbs all around there, and you know what? There's enough growth drivers here in this particular capital city to ensure that you've got good growth over the next 15 years. Yeah, because with property you want to hold on to it for a 15-year time frame. Now, if you want to manufacture some growth, you've got to be a little bit more strategic, i.e. buying below the median, and ensuring that you've got some capital behind you to add that renovation, to do a development approval, to do a small subdivision, whatever it may be. You need to ask yourself, what are you capable of doing? And it comes down to, what will the banks lend you, right? The banks look at two things: income and collateral. Income being serviceability. Collateral being deposit, right? Those are the two things that the banks look at, right? If your income is high enough, the banks will throw money at you, depending on what asset they're throwing their money on towards, what collateral, right? Because ultimately what the banks want to do is make money off the lendings that they're lending out. Yeah. So the safer the investment, the higher the likelihood you're going to get the lend, and the higher the lend it's going to be in terms of loan to value ratio. Something to consider. Ensure that you're within this 10 to 15 kilometer radius. And if you're not, make sure you've got some good reasons why. There needs to be some growth drivers, i.e. infrastructure changes, private spending, good demographics, right? There needs to be people wanting to live in that area. Maybe not now, but certainly in the future. Now, what's your strategy? What kind of timeline are you working with, right? What kind of returns are you after? You've got to ask yourself these things so that you can actually start building a strategy for your particular circumstance. Everyone's obviously different. Long-term capital growth with leverage, in my opinion, is one of the most powerful ways to build your wealth. There's only so much dollar cost averaging can do in a portfolio that we covered off on in video number 2. Right? You need to understand how this works, because if you couple this with dollar cost averaging in an income in a diversified portfolio, you can create a really, really good result for yourself, your family, and your loved ones. And ultimately, that's what it's all about. Creating a net asset and momentum building process to have the ideal income to provide you the financial freedom that we all deserve. Yeah? So that we can make a massive dent in the world. Yeah? All right. Acquisition timeline for residential property. How does it all work? You have to understand what your borrowing capacity is. They look at two things: what kind of income you're earning and what kind of deposit have you got. The banks will give you a borrowing capacity and essentially give you a yay or a nay, give you a tick on what kind of range of prices that you can work with. Understand the capital requirements, like the deposit, right? You can work with a 20% deposit, 10% deposit, 5% deposit. A lot of people fall in love with 20% deposit purely because you don't get to pay lender's mortgage insurance. Now, we're going to be talking about that a little bit later, so please stay tuned. Yeah? Because sometimes it's okay to pay lender's mortgage insurance. Commit to a strategy. At the very, very start of the process, you need to know what your exit strategies are. Because if you don't, you're going to be squandering time. And when you got time working against you, all it's doing is pushing your wealth curve downwards. Like I said, every single year you get there faster, saves you whatever your strive, thrive numbers are. I.e., if you got a goal of $300,000 per annum, And if you get there 5 years faster, that's $1.5 million worth of income in your pocket. Yeah, that's the power of this thing. So every single year you don't do something to optimize your finances moving forward, you're missing out on those big numbers. So you need to understand how to bring it all together, have a strategy in place, know what you're trying to do, know what kind of outcomes you're trying to achieve. Go for it, pull the lever, build confidence, right? That's the key. Commit to a strategy. Is it going to be a principal place of residence or an investment property, right? Research 3 different suburbs that fits your requirements. Yeah? Understand pricing disparity within your suburb. Does it have all of the growth factors inside of your suburbs? See more than 50 properties during your search. So important. You do not want to be going in there blind, because I can guarantee that you're not going to be able to pull that trigger when you see an opportunity, purely because you don't have the confidence, and confidence comes from knowledge, and knowledge comes from experience. Yeah? You need to experience this thing. See as many properties as possible. Realestate.com.au is a fantastic resource, but you need to get your feet inside these doors and actually see what you're up against, see the other buyers out there, and soak it all in, so that when you go in and see the right property for you, you're going to be able to make a move right then and there, because you'll know it's a good deal, and good deals do not stay on the market for too long. Yeah? Talk to your solicitor and conveyancer about the contract. Ensure that you got these people in place first and foremost before you sign anything. Send it over to them, right? Get them to have a look at it, just in case there are a few pitfalls that you weren't aware of. Yeah? Make an offer, right? Understand that everything is negotiable, right? Building in pest, make it a deposit. Deposit doesn't have to be 20%, it can be 5,000, right? Written offer is best, because the agent is legally obliged to show the vendor the contract if you've got a written offer in place, right? Understand that you've got to put a finance clause in there, ideally 21 days or more, yeah? Because right now it's getting really tight in terms of finance, and the banks are finding it really, really difficult to approve within a 7 to 14 day period. So give yourself as much time. It's a very, very volatile situation. It's a stressful time. And if you can get all your ducks lined up, what's going to happen is you're going to cruise through it without so much stress. A lot of people have the worst experience when buying properties, therefore they never do it again. You need to get it all lined up so that it's a smooth, enjoyable experience moving forward. No surprises, whatever you do. Right? That's the key. Understand that there are multiple variables that you need to play with, and understand the risks and consequences associated with each one, and risk mitigate the whole way through. All right, Suburb Report giveaway. If you are interested and if you are looking at suburbs currently, we are happy to send you through 3 suburbs that you're currently pinpointing. Yeah, so make sure you add your details below, shoot us through what suburbs you want, and we'll have that sent through to you. We send this out once a week, so please be patient with us. It's not an automated process yet. Yeah? Okay, so this gives you on median house prices, average suburb growth over a 15-year period, peak selling periods, pricing segmentations, what kind of people live in that area, whether it be home owners, tenants, recently sold properties, and rental statistics as well. So there's a lot of information in those things, and it actually gives you that confidence that I'm talking about to actually pull that trigger. So if you are interested in a few suburbs, make sure you leave your name, and we'll send that through to you by the end of the week. Okay, tips from the pros, right? What are the growth drivers? Demographics, infrastructure, and private spending. Those are the 3 main things that you need to consider when looking at a particular suburb. Also understand that every suburb is its own market. The biggest bugbear that I have with the media is they like to put things in aggregate, right? Queensland has gone up by 14%. Queensland or New South Wales has gone down by 5% this quarter. Not good enough. You need to really start pinpointing and honing in on each suburb, because each suburb is very, very different. And you know what? Each street in every suburb is different as well. You need to get down to that kind of nuance, because if you're working on a state level, you're not going to win in this game. It's too scary. You need to really understand what your suburb's all about and be confident that this suburb's going to produce the results that you're after. Yeah? each suburb's own market. Do not invest on the odd man out. No main thoroughfares. Don't invest on a property on a massive road, right? Always make sure that you're investing in a quiet street. Close, but not next door to the action. Interesting. The agent is your friend. They're not your enemy. You need to make sure that you're, nice to them. Talk to them like you would a friend. What you're trying to do is extract as much information as possible so that you can negotiate with them, work together with them, because it's amazing. If you treat them well, they'll actually provide you with more information that they need to provide you. Yeah, because they want to work with people who are easier to work with, right? It is in their best interest to put forward the best offers to their vendors. Therefore, if you're nice to work with, if you're being fair and reasonable, they'll work with you. They are not the enemies, but understand that they're working for the vendor, right? So be nice and understand your rights as well. You're negotiating with them, right? Don't take it to heart. Sometimes, they'll play games with you, but ultimately what they're trying to do is do a good job for the vendor. So just keep that in the back of your mind, right? Know what the vendor's motivators are. Play the game, right? Everything is negotiable. Now, the questions to ask the agents are, why are the vendors selling? How long has it been on the market for? How much would they accept today? And are they motivated sellers? These are the 4 main questions that you should ask every single agent that you work with, because you know what? You just never know. If you get a good answer, you may want to pull the trigger right then and there. Right? Beware of flooded areas. Obviously, Brisbane has had 2 major floods in the past 40 or so years. You need to be aware of where these floods hit, yeah, because it can affect property prices. Don't get emotional. It is so easy to say, but so hard to do. But please get your ducks lined up and make it very, very smooth for yourself. If you get your ducks lined up, it makes things a hell of a lot easier. You won't stress so much. It'll be nice and easy, and you might want to do it again in the future. Manufacture value, that's another one. Look, if you can buy at $400,000, add $15,000, $20,000 to it, and add $100,000 worth of value, suddenly you're working with big dollars, right? So myself and my wife, we bought a property at $500,000. We put approximately $15,000 in one of these renovations, and that $15,000 investment on a renovation actually added $120,000 on the value of the property. That is a huge return on the investment right there. This is the power of doing your research, understanding what you're trying to do. Now that strategy right there is actually putting a 3rd bedroom in the property, right? And adding a 2nd bathroom. So it was a 2-bedroom, 1-bathroom house. Now it became a 3-bedroom, 2-bathroom house, and we added about $120,000 on the value just like that. Something to consider. Very, very interesting strategy. Speaking of strategies, what are strategies? What are the strategies that are available for you as an investor? Like understanding the control versus ownership paradigm. If you can control the $400,000 property, it's okay to have a bit of debt on there, providing that you can manufacture value for it, or providing you're happy to hold on to it and the cost associated with it isn't too high. Yeah, so there's buy and hold, buy, renovate, hold, or sell, right? Buy, develop, and hold, or sell. Buy, renovate, develop, and hold, or sell. You do not want to be selling too much of these, right? The idea with this particular strategy is to only really sell when you have to, yeah? And when you have to, being if you're in a tight corner, which you shouldn't be because you've already planned it all out, but if you do, you may have to sell, right? Or if you're trying to manufacture at the top end of your borrowing capacity, you're trying to manufacture more and more income, right? So you've always got 1 or 2 deals running at the same time. So that's what advanced investors typically do, advanced active investors, yeah? So ideally, with wealth, you want to hold on to it as much as possible, purely because as it grows in value, you're capturing the compounding of the compounding of the compounding. You're getting that compounding effect. It's all about momentum building, hitting the ideal income, yeah? Investment concepts, debt can be your ally. Most people think that all debt is bad, not necessarily so. You want to work with good debt, yeah? Good debt is where it's at. You do not want to be having personal loans credit cards, car loans in your portfolio if you can help it. Yeah, always work with investment loans and principal place of residence loans because it gives you that flexibility. Have that offset account because investment properties give you tax deductibility at costs, right? Yeah, so understand the concept of control versus ownership and leverage your returns. As per this particular example right here, buying a property 100% outright at 10% growth over a 1, 2, or 3 year period, it's getting you 10% return. Now, if that is leverage with a bit of debt in it, that 10% return, it goes up to 100%, right? And in a few slides, we'll be going through an exercise of the different kinds of deposits that you can put down to see what kind of ROI you can get for your investments, right? With property, you can control 100% for as little as 5% down. Now with shares, you can do so as well with as little as 30% down, but the issue with shares is that there's this thing called a margin call. If the shares drop in value and you get caught, you could lose all of your money. You do not want to be taking that kind of risk. Let me say that again. If you buy shares with leverage, you could lose all your money if it drops down in value. With property, not necessarily the case, providing that you keep paying the banks on the repayments that they're asking for. That's the major difference. That's why the banks allow high loan-to-value ratios in property, purely because they know if you're happy to pay for it, they'll keep it as an asset for themselves. Not like America where you can just throw the keys away. Not the same here in Australia. You can't get away with that kind of stuff. You have to pay down the debt. Calculating growth for return on investment on property. Now, I apologize for the small font here, but in the end of the day, there are 4 kinds of scenarios here. One being 100% of the property value that you're putting down. The other one is 20% of the property value as a deposit, 10%, and then a 5%, right? Now we're calculating the return on investment over a 15-year period, yeah? Assuming that the property grows in value by approximately 5%, i.e. doubling over a 15-year period, yeah? So now the buy price is $500,000. Over that 15-year period, you're looking at $1 million property. It's just doubled in price. At 5% return, it doubles in price. Property prices typically double at 5% return growth per annum, compounding over a 15-year period. Yeah? So now that $500,000 property is now $1 million. If you put 100% of the deposit, you just earned yourself 4.72% return compounding over that 15-year period. If you put a 20% deposit purely on growth, not calculating the income component of this investment, you're looking at a 12.68% compounding return. Big difference because you put in a 20% deposit. What if you put a 10% deposit? That 10% deposit is now 17.33% return. Huge. That's over 15 years, yeah? What we're not saying here is the fact that for the first few years you're getting huge, much bigger returns because as the years progress, your net asset within the property is starting to grow, yeah? And at a 5% deposit, you're looking at a whopping 22.5% return on investment on your compounding return on investment over that 15-year period. 22.5%. This is a major contributor to get to your ideal income a hell of a lot faster. You need to know how to play in this space. If you don't, you've got a 30 or 40 year journey ahead of you. Yeah? How do you calculate it? It's a bit of a complicated calculation to make in terms of the compounding rate. It's an annuity calculation basically. Ultimately, it comes down to what kind of net asset return you're getting. Yeah? Comes down to your ROI and your cost of capital and risk-free return. If this ROI is getting you 22.5%, why aren't you doing it? Right? You gotta ask yourself these things. And you know what? The biggest reason why people don't do it is because of lenders' mortgage insurance. Right? I'm of the opinion that maybe it's okay to get lenders' mortgage insurance if you can get 22.5% return compounding over a 15-year period. I don't know about you, but it's okay to shell out 2 or 3% of the property price that's capitalized on the loan, i.e. added onto the loan. Because what happens is over that time of the loan, you know what? The lender's mortgage insurance is actually negligent. Now, it doesn't really mean anything, right? Because with this particular property, $500,000 worth of property that you bought, you put in 25 grand. Let's say you had to pay approximately $15,000 worth of lender's mortgage insurance that's capitalized into the loan. Over that 15-year period, it's doubled in value, right? $500,000 is now $1 million. Who cares about that $15,000? Yes, you would have had to pay some interest repayments on that, but guess what? You've just made yourself $500,000 on as little as 25 grand, right? So this is the major thing that I want you guys to consider is control versus ownership. Most people are obsessed with paying it down. You do not necessarily need to do that, because if you're trying to get the best ROI for yourself, having good debt and putting leverage in your portfolio is one of the best way to do it. Now, there are massive risks associated with it. You've got to do it right. You've got to have the cash flows sorted, and you've got to do the research behind it. You've got to get professionals behind you to risk mitigate the whole way through, because if you get it wrong, a lot of people do, and a lot of people get lucky as well, right? So if you're happy to flip that coin and test your luck, go for your life. But why you're watching these videos is you want to educate yourself and ultimately provide yourself with more and more information to give you that confidence to pull that trigger and to make it happen. Yeah, you really do not want to be focusing on the typical way of doing things, which is the status quo, right? You graduate, you find a job, buy that car, save up for the house, get married, have kids, work for 30 years, hope and pray that you've got enough superannuation. It's not a good enough strategy. All right, so this one here is the case study on mortgage payment. Now, the question here is it necessary to pay down your mortgage? I don't know, what do you think? I ask people this all the time, yeah? And one of the main things that I ask them is, do you see yourself living in this place in 30 years' time? Is this your dream home? If their answer is yes and yes, maybe it's worthwhile paying for it. But if it's not, consider this, right? This particular scenario here, you've got a principal place of residence of $500,000 with a value of $400,000. That's an 80% loan to value ratio, yeah? To pay off in 30 years' time. Now, good properties typically double every 10 years, i.e. get 7.2% growth. Not every single property does that, right? Some people have gotten more, others have got less, yeah? Now, the principal repayments on this thing is $13,300 per annum on average, right, over the 30-year period. Now, the assumption is this: 5% growth per annum on a $500,000 property. You hold on to it for 30 years, it doubles twice, right? At the 15-year mark, that $500,000 property is now $1 million. At the 30-year mark, that $1 million property is now $2 million. Yeah? Easy mathematics, right? So the mortgage is paid off. This is the ownership paradigm, right? This is the ownership paradigm where you pay the mortgage off over a 15 to 30 year period. In this particular case, it's 30 years. Your house has doubled twice in value. It's now worth $2 million. The net assets are at $2 million. Now, what if we change something here? What if we go with a control paradigm and we have the idea of not paying the debt off over a 30-year period? Is that possible? Yes. You just got to be strategic about it. You got to know what to say, how to do it, how to structure it. Right? Now, that $13,300 per annum that you pay as principal repayments gets invested, right? Same numbers here. Over that 30-year period, that $500,000 property is now $2 million. Let's have a look at this now. Same $400,000 debt, still there, over that 30-year period. If you were to invest that $13,300 per annum of principal repayments that you would have made over that 30-year period, and get 6% for that over a 30-year period, the value of that is now $1,051,000, adding an extra $651,000 worth of net assets to your balance sheet. Let me say that again. Instead of paying that $13,000 into your debt over that 30-year period, $13,300 over 30 years, if you were to invest that at 6% compounding, what will happen is you'll have an extra $651,000. That's just 6%. Now, what if we up that to 8%? You'll be $1.1 million better off. Let me say that again. If you can invest that $13,300 that you would have paid for your principal payments to own your property outright, over that 30-year period, and if you can get 8% compounding for the next 30 years, you're going to be $1.1 million better off. Now, didn't we just talk about some returns before? Like if we go back a few slides earlier, we're looking at a 12.68% return compounding over a 15-year period if you put a 20% deposit down on an investment property. So, let me run this hypothetical by you. What if you save that principal repayments over a 5-year period and use that $13,300 by 5? You're looking at approximately $65,000 or so, $67,000, right? Worth of deposit to acquire another $400,000 property in 5 years' time. What is that property now going to do for you? Get you 12.68% per annum over a 15-year period. And you know what? You can see how it starts to grow. Okay? That's the power of this thing. Just with an 8% return, you're looking at 1.1 million dollars better off on your bottom line. What if you started investing into more investment properties? What if you had more diversified portfolio growing at a rate of 10% per annum of your income? You start putting all of these things together as per the investment philosophy, and it becomes a very, very powerful money-making machine for you to achieve your financial goals. Your survive, strive, and thrive numbers are now looking a little bit more realistic, right? If you're being a little bit more strategic about it. Now, this is not the way most people think, unfortunately. And that's why they're on the path of status quo, and that's fine. But in the end, if you want to get there faster, you need to think a little bit more laterally. You need to explore what options are available to you, and you need to understand it to be able to pull the trigger. Yeah? You got to challenge the dogma. Now let me ask you this question. Is it really necessary to pay down your mortgage now that you know what you can do? Everyone's different. It's up to you. Most people have it in their minds that they have to pay it down, and that's cool. But guess what? They're going to take their time in achieving this thing. And like I said, every single year you don't get there fast enough is costing you that $300,000 Thrive number that we're talking about. Every single year. Over a 10-year period, that's a $3 million hit that you're taking. That is the cost, right? That is called opportunity cost of not optimizing your portfolio. Common strategies. Sell to upgrade. This is what a lot of people do. Sell, upgrade every 5 to 7 to 10 years. They just do that again and again and again and do not realize the transaction costs associated with that they're losing out on their wealth curve. Yeah? Overcapitalize on renovations because they've just made so much money on the previous upgrade and blah, blah, blah. Or they can afford to go a little bit more luxurious with the costs and it's fine, or we've already made that money anyway. It's just the path of least resistance leads to basically stagnation, comparing yourself with the others, and you got to ask yourself, are the people around you actually doing something well in terms of their finances? You know, and you just never know until you look under the hood. You know, it could all be a massive facade. You need to be careful. Yeah, buying with emotions, that's another big one. So many people just force the transaction purely because they just want in now. It's okay to wait an extra 6 months if you're doing the right thing. Because if you make the wrong step, you could be stuck for 5 or 7 years. I don't know about you, I'd rather take a 6-month hit than a 5 or 7 year hit. You know? You got to check your emotions. You got to make sure you're very, very logical in the way you think so that you invest with caution and you invest with strategy. Typical strategy will get you typical results. Pretty basic stuff, but it's true. Always consider return on investment, cost of capital, and risk-free returns. The financial decision-making framework that we talked about in video 2. All right, LVRs and LMI, some key takeaways. What is LVR? Loan to value ratio. LMI, lender's mortgage insurance, right? Lender's mortgage insurance is for the banks. It covers the bank's butt. It's really that simple. It's not insurance for you as the buyer of the property. It covers off on the insurance of the bank for the banks, just in case you don't pay the repayments, right? And it's typically for any purchases with higher loan to value ratios than 80%, right? What typically happens is as you creep up above 80%, the LMI, the lender's mortgage insurance, starts to go up to 3 to 5% basically, depending on what the economic environment is at the time. Yeah. Sometimes it's okay to pay for lender's mortgage insurance. Other times it's not. It depends what kind of strategy and what kind of exit strategy you've got in mind for your particular investment. Yeah. You just got to know what you're trying to do in the first place. What are you trying to achieve? You know, and just play with the variables. Make sure it works for you. Yeah. All right. Loan to value ratio. It's as simple as this. On a $400,000 property, you've got to ask yourself, what is the loan amount? And what you basically do is you get the loan amount and you divide it by the value of the property that you buy it at. It'll give you a percentage, and that is the loan to value ratio. Very, very basic stuff. All right, the control paradigm, positive carry. Now this is another one, another layer to add onto what we've covered off on, right? Now there are a lot of lazy equity out there, people who are sitting on hundreds of thousands of dollars in their home purely because they're obsessed with owning it outright and paying it off as fast as possible when they know they're not going to be living in there for a very, very long time, right? So what they've done is they paid out that loan. The value is screamed up, it's gone up. They've only got 5 years to pay for it off. But guess what? What could they be doing in those 5 years? This is the positive carry trade, right? What if you can achieve a low risk return of 4 to 4.5% per annum on the money that you've got in your current home, right? Would you use it? Would you do it, right? Okay, if you control a property with less than 80% LVR, i.e., an example right here, $500,000 value, loan of $200,000, right? So what kind of LVR is that? 40% LVR. Now the banks will lend up to 80% at the drop of a hat, depending on your age, right? The banks will lend at 80% with no issues whatsoever. What you can do, that $500,000 and the $200,000 loan, you can actually get something called a top-up loan as per this image right here. Let me just draw it out for you. That's a $200 loan, $500,000 property, $200K loan. What you can do is you can do a top up. You can pull out $200K and then invest it however which way you want. Now the idea here is to not invest it on a holiday, not invest it on a new car or a new boat or a Ferrari or whatever kind of luxury item that you want, because ideally you want to be investing in things that appreciate in value to achieve your ideal income. That's what it comes down to. Achieving your ideal lifestyle, financial freedom, so that you can make a change or whatever it may be. Whatever floats your boat, everyone's different. Yeah? So the idea here is to pull out that $400,000 investment loan and invest it accordingly, according to a philosophy of sorts, potentially. I don't know. That's an option, you know? And what if you were to invest in an 8% fixed income environment, right? You can get, on that $200,000, you can get an extra $8,000 bucks in your pocket on a year-to-year basis. Now, what can you do with that $8,000? You can either reinvest that here, or you can put it towards lifestyle. It's just sitting there. You know, if you're in a position right now where you've got a $500,000 and $800,000 home with no debt on it, what you can do is you can pull some out and test the waters and see what you can do with it. You know, maybe you can buy another investment property. I don't know. Right? What if you can combine both strategies? You get a fixed income play and buy another investment property. Right? If you look at that right there, sorry for the small font, but ultimately what it's saying is you pull out $200,000, you use $50,000 for an investment property. You use $150K to fund the investment property shortfall. So As a cash flow position, you're in the same position on a year-to-year basis. All you've done is you've now acquired and controlled a $400,000, $500,000 property. Powerful stuff, because guess what? Over a 15-year period, that property may double in value. You know, something to consider. What if you do 2 investment properties? Two $50,000 and invest $100,000 to work on the shortfall. Very, very possible. You got to get your cash flow sorted. You got to understand the risks associated with it. If you get it right, you can tweak these things so much so to actually get the momentum you need to hit the wealth curve that you want, right? Principal place residence versus 2 properties versus principal place residence versus 3 properties. This is the major difference. Like if you look at this, I don't think you'd be able to see that too well, but ultimately the major difference is $600,000 is the difference between the 2 of them. Right? One with picking up an extra investment property or picking up two extra investment properties from where they are. Right? Relative to where they were going to be, they're about $1 million and $1.6 million difference. Just by changing one thing and getting time on their side. Powerful stuff. People don't realize what they're missing out on purely because they choose to close their eyes and they don't listen. And fair enough, because you know what? The finance industry hasn't really made it easy for us, for the public, to learn more about these things, right? So my goal is to provide as many people as possible with this practical information so that they can actually set themselves up for a fantastic financial future where they've got a multitude of options in front of them instead of being cooped up stressing about their finances. So where do you start? It's understanding where you are today, right? Your income, your expenses, your assets, liabilities. Understanding where you are today, how are you tracking for tomorrow? Get the wealth curve from video 2. Do the exercise. How are you tracking? What do you need to do? What do you need to change in your life, right, to achieve those goals? Understand your trajectory. Make sure you're on the right path to achieve your survive, strive, thrive numbers. That is what is the key to this thing. That's the end goal. That's point B. Yeah? Understand where you are today. Now, is the status quo for you? I would like to say that it shouldn't be, now that you know what options there are available out there. Yeah? It's time to get a move on. It's time to get something going for yourself. Right? If it's too difficult and if you want some help, give me a call. Click on one of the buttons above. Contact us. Happy to sit down with you and go through what your options are. You know? Happy to help. Happy to help. Whether you become a client or not, I don't really mind so long as you're spreading the word and you're actually building something significant to make a difference for yourself, your family, and ultimately the community, ideally. Thank you very much for your time. This has been video number 3, where we went over property and how to bring it within your current investment portfolio. Good debt, bad debt, control versus ownership. You need to consider this as part of your investment portfolio, because if you're a shareman or a funds management guy or girl, you're missing out on the flexibility that property brings you. You need to bring it all together. You need to put some good debt in there to actually bolster the chances of hitting your ideal income faster. Right? A lot of things to cover off on, and I'm sorry if I went too fast, but what you can do is you can replay this video again and again if you like. I don't mind. Thank you very much for your time. I shall speak to you and see you in video number 4. Thank you. If you've got any questions, make sure to reach out via Instagram at Andrew David Courtney, and I will see you soon. Thanks very much.